Thank you, 2022 stock market. Am I crazy? What does any investor have to be thankful for in 2022? Well, to better understand that, let's take a look at what's happened over the past year. If we look at these 5 ETFs, you can see over the past year, the Dow Jones Industrial Average has been the best performing of these, followed by the S&P 500, followed by small caps, followed by the NASDAQ, and followed by innovation. This is an extremely unhealthy looking stock market. And you can see that in the returns here in the table. Dow Jones Industrial Average down 7%, S&P 500 down 18%, small caps down 20%, NASDAQ down 33%, and Ark Innovation down 67% since 12/31 of 2021. Since we're looking at how much these indices have fallen this year, it's really instructive to take a look at how much would they need to recover to just get back to where they were a year ago. Well, you can see here I've listed them in this table, and I'm showing the 1-year returns that you just saw previously. And I'm also showing the 5-year compound annual growth rate. This is kind of like the average return that these things would have returned over the past 5 years. And then I'm showing the compound annual growth rate since the inception of each one of these, and the start dates are up here that you can see. So if we were just to get back to where we were 1 year ago, what would that take? Well, in order to make up an 18% loss in the S&P 500, you have to have a little bit over a 22% gain just to get back to even. For the Dow, it's a little smaller because they fell less. For the NASDAQ 100, almost a 50% return just to get back to where you were a year ago. Small caps, almost 26%. And Ark Innovation, a whopping 200+%. That's a 3x from where we are right now. Let's take a little bit of a different view, though. Let's take a look at the compound annual growth rates that you would have found for each one of these 1 year ago. So you can see them here. I've highlighted them in green. If you look at the compound annual growth rate since inception, for example, for the S&P 500, it's up 19.48%. But if you look at the compound annual growth rate as of 1 year ago since inception, it was running about 10.6% per year. So it's lost a lot of ground here because of this terrible year we had this last year. And you can see that across the board here. Ark Innovation at the end of last year was running at a 25% compound annual growth rate. Now, because of the big loss this year, it's only running at 6.57%. So if we say to ourselves, okay, well, if we are going to revert to the mean as of a year ago, what kind of returns would we need to get in the next year, sort of by the end of this year, to match that compound annual growth rate that we were seeing a year ago? Well, I've highlighted those in green here, and you can see for SPY, for the S&P 500, to get back to a compound annual growth rate of 10.6%, it would have to grow 50% this coming year. And how about the Dow? It'd have to grow 27%. The Qs, almost 80%. The small caps, almost 50%, and Ark Innovation, a whopping 376% return just to get back to this 25% compound annual growth rate since inception. Now, these numbers will be smaller if you try to get back to the compound annual growth rate since inception. But I'm trying to give you the extremes here between where you would have to gain just to get back to where you were a year ago and where you'd have to gain to bring the compound annual growth rate back to its mean reversion. So now, what if we look at some tech stocks instead of the indices? Well, what I've done here is I've taken Apple, Google, Nvidia, Tesla, and Roku, and I've made the same exact plot here going back over the past year. And you can see in the table, Apple was the best performer, down 26%. Google was the second best performer, down almost 40%. Nvidia came in third at minus 50%. Tesla down 65% over the past year, and Roku down a whopping 82% over the last year. So what kind of opportunities would these present going forward if these were to recover just to the levels they were at 1 year ago? Well, let's take a look. So here again, you can see the 1-year returns for each one of these that I listed earlier. You can also see the 5-year compound annual growth rates for each one of these. And For Apple, just to get back to where it was a year ago, it would have to grow almost 36%. For Google, 63%. NVIDIA, double, 101%. Tesla, 185%. That's almost a 3x. And for Roku, a whopping 460%. That's over 5x, just to get back to where it was a year ago. And let's play that same game again with the reversion to the mean on the compound annual growth rate. So if we look at these, the compound annual growth rates as of a year ago, before this big drop, were almost 20% for Apple, 26% for Google, 33.5% for NVIDIA, almost 60% for Tesla, and 70% for Roku. Now, in order to get back to that level in the next year, by the end of next year, Apple would have to almost double by 95%, Google 160%, NVIDIA 258%, that's over 3x, Tesla 568, almost 569%, that's over a 6x, almost a 7x by the end of next year to get back to its reversion to the mean rate of growth that it had the end of last year in 2021. And Roku, a whopping 1,500% to get back to that 70% growth rate. Now, I think it's highly unlikely these stocks would perform this way, but I would say this is an extreme outlier that could happen, maybe, if things go really, really well. While there's no guarantee these ETFs or stocks will get to their high water marks, as I've shown here, this analysis does give some idea of the potential opportunity going forward, and it looks pretty juicy. Now let's get back to some of our normal programming and talk about the current health of the stock and bond markets and gold and crypto. I think it's instructive to look at the one-day performance on the last trading day of the year, because it really is kind of an indication of a healthy rally here. You can see that the Ark finished the highest for the day, up 0.22%, followed by the NASDAQ, almost flat, followed by the Dow Jones Industrial Average, down 0.22%, followed by small caps, down 0.28%, followed by the S&P, down 0.33%. Now, if this continues going into next week and the higher risk stocks like Ark and the Qs outperform everything else, then we're starting to look like a healthy stock market. But let's look at some of our other indicators, because maybe we're not quite there yet. If we look back over the past 5 days, you can see that just looking at the endpoints, this is an unhealthy stock market. The higher risk stocks finished the week down the most, or underperforming the rest of them. The Dow Jones Industrial Average finished the best for the week, and that's not a healthy rally. But let's take a look at what really happened here. So if you look at where these bottomed out back here, I think this was probably about Thursday or Wednesday, you can see that Ark shot up the most. If you were to line these up on this day, Ark would be way up here somewhere. And the NASDAQ 100 would also be higher. So from this point forward, we started to have what looks like a healthy stock market rally. Now let's take a look at the current dynamics using our bottom analysis tools. You can see that we have a falling bottom forming indicator. We didn't get a bottom forming indicator at all here. Maybe you could argue this was one, but it's pretty weak. But what's interesting to me is this bottom forming indicator is falling, the bottom confirmation indicator is rising really rapidly, and the confidence level is going higher. This indicates to me that we could see a rally next week. And what if we look back going over the entire year at this bottom analysis to kind of give you some perspective on what's happened? Well, you can see that, first of all, the price action of SPY has just been falling to this point. And then we've been trying to go higher, but kind of failed. So here we are. So where does this leave us? Well, we had back here, we had a bottom forming indicator, a very strong one. Here we had another bottom forming indicator, a very strong one. And here we had a bottom confirmation, a fairly strong one with a high confidence level. And you can see that from this point forward, the market went up. It tried to have another bottom forming indicator here, but it failed. And then you can see it's fallen back here. I don't quite know what to make of this. You don't always have to have a bottom forming followed by a confirmation. This could very well be the bottom here. We have to wait and see how this performs going forward. And what I've also added here is this green line, which is some logic that we put around this. It's not definitive. It's not something I would try to trade necessarily. It's just another input into what's going on in the markets. And you can see that it was out of the markets all of this time. It got into the market here as this started to rally, got back out here as it started to fall, got back in for a little while here, which ended up not being good. And then it got back in back here and has stayed in until this started to falter. So right now, currently, it's indicating being out of the market, but that may not last very long. We'll have to wait and see. Now let's take another look at the health of the stock markets. I said they were starting to look healthy in the last few days, but clearly in the rankings, they don't look healthy at all. You can see back here on August 17th, we had a very healthy stock market with the higher risk stocks ranked 1 and 2. Cash in the middle, and we had an unhealthy Treasury market with the longer-term Treasuries ranked 9 and 10. That's not a healthy Treasury market. On December 16th, we had a very healthy Treasury market and a very unhealthy stock market. A week ago on December 23rd, we had a very unhealthy looking stock market and an unhealthy Treasury market. This is not good. Cash ranked 1, gold ranked 2, T-bills ranked 3. This is a flight to safety if I ever saw one. And then this past Friday on December 30th, gold ranked number 1, cash ranked number 2, T-bills ranked number 3. Again, flight to safety. Stocks not looking so wonderful, with the NASDAQ ranked at the bottom of the stockpile here. And then Treasuries very unhealthy, with long Treasuries ranked at the very bottom here. This is not a good looking market at any level, but this is the way it will look at the bottom. I'm not saying we're at the bottom, but this is the way it will look at the bottom. So how does this look when we take a look at the buying and selling pressure? Because this gives us another dynamic into what's going on sort of under the covers in the market. And you can see for the Dow Jones Industrial Average, it's been falling. And you can see here right at the end that the selling pressure has moved above the buying pressure. This does not give me a lot of confidence. Now, this could flip early next week. It's not stuck in stone that it's going to continue to go higher. For the S&P 500, the selling pressure never got below the buying pressure. In fact, it started to approach the buying pressure, and then it took off and started heading higher. Again, we'll have to wait and see what happens next week. NASDAQ 100, even a worse picture than the S&P 500. You can see that the selling pressure has been steadily increasing since the end of November, and it's pointing upwards again. So this is not a good looking picture. What about the Russell 2000? Well, again, you can see that the selling pressure well above the buying pressure. We had almost an attempt here for the buying pressure to move above. It failed, and the selling pressure is heading higher again. And what about Ark Innovation, the worst looking one of the bunch? You can see the selling pressure has been steadily increasing here. It's not pointing up though like the other ones. It's sort of flat here. So we'll have to see how this one plays out as well. Now let's take a look at the sector rankings, because I think these tell another piece of the picture. And if you'll remember from my previous videos, while this one's ranked 1, you'll see there's no number 2 in here. That's because there are 3 of each of these in the model, and we discount 2 of them by 1 standard deviation and 2 standard deviations. So the way these rank, aerospace is ranked 1, energy ranked 2, healthcare 3, gold 4, and so on. So just kind of ignore these numbers. You really have to go by the order up here. But you can see what's happened here. Gold is still ranked fairly highly. Aerospace defense is ranked number 1. Energy, which was ranked number 1, has kind of fallen off here and has been faltering a little bit lately. But I like the fact that cash is moving lower. Now, I'd like to see cash fall off of this table into the bottom half of the table. But I also like the fact that technology is here. It's barely on the table. Emerging companies, the QQQJs, emerging markets, these are riskier areas that seem to be moving up. So that's encouraging if it continues. Let's take a look at the bottom ranked sectors. So if we look at the bottom ranked sectors, now technology was on both of these, so it's right at the top of the bottom ranked ones. But you can see that treasuries have really fallen off, and long-term treasuries are way down here. Now the NASDAQ 100 is here, but you can see from a week ago, it went from 53 to 52. So that's in the right direction, but it's not good enough. And you can see that the semiconductors went from 40 to 30, so that's a pretty good move. They're improving as we go forward. I'd like to see that continue. And what about the Treasury markets? Well, if we look at the performance over the last week, this is not very good at all. You can see that all of them finished almost near the bottom for the week. Not a healthy Treasury market at all. In fact, we added protection to the Treasury portion of our clients' accounts, I think a little over a week ago, to protect against this kind of thing. And speaking of treasuries, how do they look from a buying and selling pressure perspective? Well, you can see here we had a very nice rally in the 3 to 7 year intermediate treasuries, and the buying pressure was well above the selling pressure. But since about the beginning of December, you can see the selling pressure has been steadily increasing and is currently above the buying pressure. This is not looking good. How about 7 to 10 year treasuries? I call these intermediate to long treasuries. Well, again, very similar picture. A nice rally here, buying pressure well above the selling pressure, but recently the selling pressure has been increasing and it's above the buying pressure. Not a good look. Let's look at long bonds, 20-year treasuries. Again, very nice rally, buying pressure above the selling pressure, but you can see since back here, the buying pressure has been falling, selling pressure has been increasing. These really don't look good right now. And what about gold? You saw gold was ranked fairly high in the rankings, and you can see why. Had a nice rally here, and then it's just been kind of floating up slowly here. Not an aggressive rally, just kind of floating higher. And you can see that here in the buying and selling pressure. You know, this buying pressure was above here, kind of traded places again. It's not really definitive, but it's just kind of floating higher slowly. And then finally, what about cryptos, and in particular Bitcoin? Well, remember, Bitcoin and other cryptocurrencies and blockchain are all technologies, so they should act like risky technologies, at least for now. And in fact, that's what's happening. You can see it during the FTX fallout. There was a big drop. They sort of wandered lower and lower and lower. But I like what I'm seeing here. There's a little bit of a rally going on here, and the buying pressure is moving higher. Don't know if this will continue or not. Hope it does. So where does this leave us looking forward into 2023? Just now, I showed you a set of mixed signals that could indicate we're at a turning point and the worst is behind us, or not. Look, until the Fed pivots and stops raising rates and we start to see some resolve in the Ukraine war, there are very real risks that could drive the markets lower. Let's take another look at the end of this first week of 2023 to see if things are clear when it comes to the stock, bond, gold, and crypto markets. Maybe we'll have a better read by then. I'm Calvin Rose, and thank you for watching Invest Smarter today. That's all for now.